I 100% agree with him. I think it's been 5 years since the pandemic. The worst is behind us. And the indicators that we look at to see an improving market are all there. Capital markets transactions are up. Lending is up. Distressed asset sales are up, which means there's opportunities, there's capital formation, there's people who are really wanting to buy these buildings, reposition them, and get them ready for the next generation of tenants.
What's the nuance geographically here? Because we know the story in New York. We've been in New York physically for the past few years since the pandemic. It was a different story during the pandemic and post-pandemic in a place like San Francisco. But then enter, the AI boom starting 2 years ago. What happens in San Francisco?
I mean, San Francisco is looking pretty good right now. So the demand is up. It's at pre-pandemic levels. And what's really interesting is not only in San Francisco, but across the country, we're seeing the emergence of big block leasing again. Leasing that's over 100,000 square feet. And that can really move an asset's value because it's a big deal. Financial services is one of the most active groups across the entire country, but technology improved 150% year over year in terms of large block leasing. And we'd expect that to continue again in the next 2 years.
That's interesting. I mean, when you break it down at the industry level there, technology, financial services, we talked about San Francisco as well, maybe returning to its pre-pandemic normal. Is there anywhere where it still doesn't feel like we're seeing that resurgence when you take a look at your different geographies and those different markets?
No, I think across Trophy in every single market, we're seeing the resurgence. And I think that's really been the story of the last 2 years. The chapter we're entering now is the next chapter. So we know that Park Avenue is tight, using that as an example again. We've heard about that. We've seen the big Citadel transactions. But, what about areas like Hudson Square as an example, where you have Google anchoring it, you have Disney, you have Anthropic and Notion moving in. I mean, those are neighborhoods that really have the right fundamentals to see a lot of growth. And it's not just in New York, it's in areas like Soma in San Francisco as well, Menlo Park, where you really see the combination of good credit tenants and then emerging technology tenants, but also all the service providers that want to be working with those sectors. So you do see an emergence of law firms, financial services, professional services that are trying to get closer to those growing areas.
So we know there's demand for Trophy. You said that. What about Class B and Class C? What happens to those buildings? Do they get bought and converted into condos, as we've seen a couple prominent examples here in New York City? Or do they get remodeled and turned into Class A office buildings?
I think there definitely will be a substantial portion, like maybe 2% of the entire office inventory that will turn to resi. And we'll see that.
So very small number.
Very small in total, but a big compared to what it's been historically. And I think we will see that. But what's really interesting about what you just said is we all know the Trophy story is good, especially for post-2019 construction. But the Class B rents have really been holding their own. So you haven't seen those declining. So I'm feeling pretty good about Class B across the country as well. Class C, I think we're going to have to do something about. That's going to be a little bit trickier.
Well, what do you think needs to happen? What are the necessary ingredients to see that interest come back when it comes to those maybe lower quality properties? Is it lower interest rates, maybe risk appetites coming back as a result? What do we actually need to see in terms of catalysts?
I think it's just overall economic growth, which we're seeing, right? So overall demand growth in those markets, and then also just repositioning of those assets. So going back to what we said about distressed sales, in that category, the 20% or so of assets that have too much vacancy for being refinanced at the current moment, they're going to have a new buyer come in, put money into that asset and reposition it. And that's going to be where you're going to see that value change again. There might be some buildings that just need to go,
Has the catalyst been returning to the office?
Certainly in part.
You said economic growth is certainly part of it, but you can have economic growth, and if people don't need offices, then they're not going to go and get offices. Is it because there's been this narrative shift in the big cities that's like, okay, it is time to get back to the office?
I think that the narrative shift has been very definite over the last quarter, and I'd expect it to continue across all segments. We aren't seeing anyone right now who's really moving to a more hybrid environment. It's all moving towards a more in-office environment, and it's stabilizing at over 3 days a week, which means that you do need to have a full-time office for every person who's coming in.
Yeah, it does feel like the tide has certainly turned there. You did make a point that some of these buildings just need to go. When you think about some of the lower quality buildings out there, I mean, how much is that in terms of the supply? How much of that is just, it's not going to be renovated?
Yeah, I would say, low single digits. Okay. I don't think it's very substantial. I think that a majority of the office real estate across the country is in a pretty good position right now to be reinvented with the new demand that we're seeing coming in.